Hey everyone, and welcome to The Explainer. Today, we're diving into our source material to look at a genuinely fascinating company, Walker Dunlop. They're trading under the ticker symbol WD at exactly $52.34 a share right now. And we are going to put this commercial real estate heavyweight through what I like to call the ultimate valuation gauntlet. We're bringing in the legendary frameworks of Warren Buffett, Peter Lynch, Benjamin Graham, plus some modern DCF models, just to see, is this a hidden gem, or are we looking at a value trap here?
All right, let's get right into it. Here's our roadmap for today. 1, we'll do a company snapshot. 2, the Buffett lens. 3, the Lynch lens. 4, the Graham lens. 5, DCF and alternative models. And 6, our final verdict.
Section 1, Company Snapshot, Commercial Real Estate Giant.
Before we start crunching all these numbers, we really need to know what it is we're actually valuing, right? At its core, Walker Dunlop is literally one of the biggest commercial real estate finance and advisory firms in the U.S. Like I mentioned, they're currently trading at $52.34, and what they do is originate, sell, and service a massive range of commercial real estate debt and equity products. And they focus really heavily on multifamily lending.
And honestly, the sheer scale of this operation is pretty wild. Just in 2025 alone, they closed $55 billion in total transaction volume. Plus, they've been the #1 Fannie Mae lender for 7 years running. But their absolute crown jewel, and seriously, we're going to come back to this a lot, is their $144 billion servicing portfolio. Think of this as a massive recurring revenue engine just humming away in the background, pumping out cash, even when the broader market takes a hit.
Moving on to Section 2, the Warren Buffett lens, moats, and management. Okay, so when we channel the Oracle of Omaha, the very first thing we look for is an economic moat, and Walker Dunlop absolutely has one. See, every single time they originate a loan, they add to that giant $144 billion servicing book we just talked about. That creates non-cash mortgage servicing rights revenue that eventually just turns into highly predictable long-term free cash flow. You combine that kind of stickiness with their deeply entrenched relationship with Fannie Mae, and yeah, you've got a very wide, well-defended moat.
But reality bites a bit when we actually put their 2025 financials up against Buffett's super strict checklist. You know Buffett. He demands consistent earnings and a high return on equity, ideally north of 15%. And unfortunately, Walker Dunlop failed both of those tests recently. Their 2025 earnings per share dropped pretty sharply down to $1.64, and ROE just plummeted to 3%. Now, why did that happen? Well, management proactively took some really painful impairment charges to clear bad loans off their books. So, while they definitely failed the earnings test, you could argue they actually passed the honest management test because they took their medicine early.
Because of all that recent volatility, trying to calculate Buffett's favored owner earnings is honestly kind of tough. And that makes it really hard to justify paying a premium right now. Remember, Buffett wants a stripped margin of safety, usually a 20% discount to intrinsic value. So given that 2025 earnings drop and the current price of $52.34, the Buffett lens is telling us this is a solid pass for today. The core quality is there for sure, but he would almost certainly wait patiently for a cheaper entry point.
All right, Section 3, the Peter Lynch lens, growth and price. Let's shift gears completely and look at this through Peter Lynch's eyes. Lynch loves to categorize companies, so he knows exactly how to trade them. And right now, Walker Dunlop fits perfectly as a cyclical stock that's transitioning into a turnaround play. The commercial real estate market just got battered recently, which explains those heavy 2025 impairment charges. But get this, the Mortgage Bankers Association is projecting a massive 27% growth in commercial real estate financing for 2026. For a guy like Lynch, that kind of macroeconomic tailwind is literally the exact catalyst you're looking for. And here is where Lynch would get super excited, the PEG ratio. Now, if we just use 2025's depressed earnings, the stock actually looks kind of expensive, with a PE hovering near 32. But management has laid out this clear Journey to 30 plan where they're targeting roughly $9 in EPS by 2030. If they hit even a fraction of that target, the compound annual growth rate is immense. When you factor in that projected growth, the PEG ratio drops down to roughly 0.80. Finding a PEG under 1.0 in the financial sector is pretty rare, folks. By Lynch's standards, that makes it deeply undervalued.
Next up, Section 4, the Benjamin Graham lens, strict defensive value.
Now we're bringing out the heavy, super conservative math from the father of value investing himself, Benjamin Graham. Graham uses a really strict defensive checklist before he'll even glance at a stock. Number 1, adequate size. Well, with a $1.8 billion market cap, that's a pass.
Number 2, earnings stability. As we just saw, 2025 earnings took a huge hit, so that's a hard fail. Number 3, dividend record. They paid out $2.68 in 2025, so that is an absolute pass. But here's the thing with Graham. That failure on earnings stability is an immediate, deal-breaking red flag.
Just to find out exactly what Graham would theoretically pay, we're going to use his famous intrinsic value formula. It's the square root of 22.5 multiplied by the earnings per share multiplied by the book value per share. It is a totally brutal formula that ruthlessly grounds a stock's valuation purely in its tangible assets and current earning power. Let's actually run that math. We plug in 2025's depressed EPS of $1.64, and we use their approximate book value per share of $51.35. You crunch those numbers, and Graham's intrinsic value comes out to precisely $43.53. So when you compare the current market price of $52.34 against Graham's hard valuation of $43.53, yeah, the margin of safety is completely negative. The fundamentals simply do not support the current price under Graham's deeply conservative parameters. For a strict Graham investor, this is definitively a sell today. Moving on to Section 5, DCF and Alternative Models. Stepping away from the old school gurus and into modern modeling, let's take a look at the discounted cash flow. If we assume an industry average weighted average cost of capital of about 9%, just to account for those macro risks in real estate, the fair value shifts pretty drastically based on terminal growth. If we tweak that long-term growth rate between 1.5 and 2.5%, the valuation lands right around the low 50s. What that means is, under standard DCF modeling, the stock is currently trading almost exactly at its fair value.
But honestly, this brilliantly illustrates why we really need to look at alternative models too. Just look at the remarkable dividend growth history. They went from $1.44 in 2020 to $2.40 in 2022, all the way up to $2.68 in 2025. You guys, that is 8 consecutive years of dividend hikes, entirely uninterrupted by that severe commercial real estate downturn.
Because of that incredible consistency, the dividend discount model paints a much stronger valuation picture for us. Supported by a really hefty 5.2% yield today, the DDM suggests the stock actually has a much higher baseline valuation. Basically, even if capital appreciation stalls out for a bit, that steady flow of cash going straight back to shareholders provides a seriously robust floor for the stock price.
All right, Section 6, Synthesis and Final Verdict. Let's bring this all together.
We have officially run the gauntlet. And here is the guru consensus on Walker & Dunlop at $52.34. Buffett, he's a hold. He absolutely loves the moat, but he really needs that ROE to recover first. Lynch, he is an enthusiastic buy, seeing a great turnaround story with an incredibly cheap PEG ratio. Graham, on the other hand, is a strict sell, since his math demands a price closer to $43. And finally, our modern DCF models land squarely on a hold, seeing it as fairly valued right now. So, blending all of these different perspectives together, the ultimate consensus here is a solid hold. To summarize what you should really take away from all this, investing in the stock right now is basically a battle between long-term durability and short-term pain. The key strengths are undeniable, right? That massive $144 billion recurring servicing portfolio and their market-leading agency lending position. But the risks are literally staring us right in the face. They just reported over $10 million in Q1 loan repurchase losses. Basically, you are being paid a 5.2% dividend to sit and wait out this credit cycle.
Which leaves us with this final thought to chew on. Value investing isn't just about staring in the rearview mirror, it's about anticipating the road ahead. If the commercial real estate market actually does rebound by that massive 27% in 2026 like the experts are projecting, is it possible that what looks like a premium price to Benjamin Graham today is actually a brilliant bargain in disguise? Thank you so much for joining me on this explainer. Keep questioning those numbers, and I'll catch you next time.